Look, I agree with David Tepper 100,000%. Right now, the Fed is doing exactly what we would want them to do. I don't know what all this chaos is around, oh, Jay Powell, and did he do a good job? What more do you want? I mean, he literally talking about tapering. How much foreshadowing do you need in this market? We know that they're going to raise rates. They've said that for eons and eons. So unless people aren't listening, they didn't hear that. I don't know what the surprise was yesterday, other than saying, hey, we might give you 2 rate hikes almost 2 years from now. Let's think about this for a second, guys. And we don't know if it's going to be 25 bips, if it's going to be 50 bips, but they're telling you what they're thinking about for you to prepare. There are no surprises. This Fed is not trying to play games with our lives, with our money, or any of the above. I think that Jay Powell is doing a phenomenal job, and if we use our 2 ears to actually hear what they're saying and watch what they're doing, you'll be able to prepare your portfolios appropriately. I mean, again, what more do you want?
Well, I mean, Dr. J, the risk, of course, is that those rate hikes, which the dots suggest you could get 2 in 2023, could actually come sooner. Because even as Chair Powell himself admitted, inflation could prove to be higher and more persistent than they think. It's all a guessing game. They don't have a crystal ball any more than you do, Doc. So,
No.
We're giving them the benefit of the doubt for now, John Najarian. Interest rates are at 150 today. So how do you see it from here? What are people supposed to do now?
I think the key was what Courtney said there, and that is that people that are listening can start positioning whenever they deem that appropriate, Scott. So in other words, I agree with you, Court, about, this is out in the future. They've said they're going to do this, and this is, pretty far out into the future. So for somebody like me, I'm not going to be adjusting my portfolio very significantly at all for something that's out in 2023. On the other hand, there are a lot of portfolios that clearly either got nervous when they heard those words as far as, okay, well, I'm going to start adjusting now at all-time highs in the market, which you can't really blame them for, Scott, even though we think GDP is going to continue to surge and perhaps we're going to have that inflation move be indeed transitory. The jobs reports have not been as stellar as people would expect, nor have the jobless claims this morning been as positive as we all had hoped. So with the market at all-time highs, am I going to blame some people for getting to the sidelines in those Dow stocks? Because that's the sector that, or, those 30 stocks are the ones being hit, Scott. The NASDAQ, to your point, we've been up all day and moving higher, and I think those stocks continue to work that way. So it really depends on what your portfolio is. Does it look more like that Dow portfolio, or does it look more like the NASDAQ portfolio?
So, Farmer Jim, one of the comments we hear quite often from people around Wall Street is, I'm going to pull a Wayne Gretzky. I'm going to skate to where the puck is going rather than to where the puck is today. I say that as I read a Rick Reeder tweet from literally seconds ago. It's time now to set up for the end of this long-running hashtag emergency policy focused movie. So if that is the case, how are we supposed to prepare today for where the puck rates are eventually going down the road?
Let me start answering that question by saying how the market's answering it, okay? Everything in the market today is saying, oh, my goodness, the Fed's getting hawkish and it's going to crush growth, economic growth. That is so laughably wrong. And what I'm talking about right now is you mentioned the 10-year. That's one of them. Crude oil off 2%. But the 200 basis points underperformance of large cap value versus large cap growth is the market's way of saying the puck is going to slower economic growth. I think that is laughably wrong. I think it's laugh out loud wrong. You still have vaccines and reopening. You still have economic stimulus. And biggest picture of all, we're talking about the Fed raising rates 2 years from now. 2 years, I cannot make portfolio adjustments on what may happen 2 years from now.
Remember, though, Jim, that the dots are
not at the
written
latest.
in Sharpie.
Not at the latest.
They're not written in Sharpie.
No, it's not.
I mean, if things get a little
no,
bit
but it's
hotter.
it's not at the latest. It's not at the latest. Okay, that's where the median dot plot says liftoff will happen is mid-2023. The median dot plot. All right, there are people who think it's going to be earlier on the board, and there are people who think it's going to be later. But I'll tell you what, I'll play the game with you. Let's say it is earlier. Let's say it's 18 months. Let's say it's at the beginning of 2023. That's 18 months from now. Right now, you've got people who are traveling again. You got people who are spending on restaurants again, buying cars. You got iron ore manufacturers pre-announcements, auto manufacturers pre-announcing positive. This is a time for playing economic growth. And if you're giving up on the value trade right now, you are wrong. You're going to be sorry.
Okay.
You're going to be sorry.